The Consumer Bankers Association is pleased to welcome you to today's webinar, Leveraging Valuation and Appraisal Technology for Profitable and Sustainable Growth in 2023, presented by Accurate Group. My name is Isabella, and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are of those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to introduce our speakers. Frank Wanera, Director of National Sales at Accurate Group, and Michelle Golden, Chief Appraiser at Accurate Group. Frank and Michelle, welcome.
Thank you.
Thank you, Isabella.
So, Isabella, I think we're going to get started with a couple of poll questions for the group. We really appreciate everybody's time today and joining. And we've got a couple of poll questions I think we want to start with just to kind of get a gauge of what's happening with our participants. So if we could start our first poll question. Do you use valuation products other than full appraisals within your home equity program? Just a quick yes or no on that one. We'll give everybody a second to answer that. And then before we move on to the next poll question, we're going to display the results for the group. That's pretty
Awesome.
Good. Yeah. So,
pretty, and not overly surprising given where we are, right?
Right. It's interesting though, because we are going to talk about, the expanded valuation box. So that's interesting. Okay, Isabella, could we go on to the second question, please? Okay, so do you use valuation products other than full appraisals for first mortgage transactions, which are held in portfolio and not sold on the secondary market?
See where this goes.
Yeah, this will be an interesting result.
Mm-hmm.
All right. That's actually a little bit higher than I thought. 83% were using it in home equity, 63 in in portfolio. So it's higher than I thought it was going to be. I don't know about you, but I was expecting probably, at best a 50-50 split.
Yeah, that's what I was thinking too. Given that there's so much new coming out.
Sure.
People aren't quite adopted yet.
All right, let's do the third one, Isabella, and then we'll get into kind of what we're talking about here. So what do you anticipate the market trends for home equity to be in 2023? Appreciating, stable, or depreciating? So, what do you think the market is going to do? Home equity market is going to be in 2023, I guess is what we're asking.
It's almost like we should have music in the background.
Right?
For Jeopardy or something. Right. Yeah. Let's have Jeopardy music in the background.
All right.
Huh. Okay.
So this sort of lines up with so for the group's benefit, we did survey our customers to find out what they thought the trends were going to be. And this is pretty close to being in line with the results that we got. Kind of an even split on the stable and depreciation. There is a few of our respondents, customers, that feel there's going to be an increase in home equity. I know there's There's a few out there that are doing home equity campaigns, so that might lead to the increase. But I think it's almost in line with what we were hearing from our customer base. So pretty interesting. Thank you, Isabella. All right, so kind of want to maybe just start digging into this. We've been talking about, so when, Michelle and I were talking prior to the presentation on, what is the current state of the market right now? And I think we're all painfully aware that there was just a drastic and unprecedented rise in interest rates that really caused purchase and refi lending to, I don't want to say seize up, but it fell off a cliff. The CNBC reported that in September of 2022, refi activity had declined 84% over the previous year. So it's been certainly a challenge, I think, for all of us. I almost hesitate to say that it seems like rates are starting to stabilize, but that's almost on a day-to-day, depending on what news hits or what Fed Chair Powell says. I know we've got a Fed meeting coming up next week, so I think we're still in a little bit of flux. We're starting to see, at least in our business, demand for HELOCs and home equity loans and orders starting to tick up a little bit. Again, that's kind of a time will tell. It's interesting. There's a lot of a lot of reports coming out about the health of the consumer. So I think as the year goes on, this will certainly play out. There's a ton of layoffs though, and I think that really for us, we're hearing from a lot of our customers that these massive layoffs may result in the potential for borrower defaults. The consumer is still pretty strong, but there's a lot of layoffs. Michelle, I don't know what you're hearing, or have you on your calls? I know we're not on the same calls, but what if you're seeing in the industry, what are you hearing that maybe differs from this, or is it the same?
Yeah, pretty much the same. When it comes to the home equity lending, we've been talking to some of our customers in that space when I'm having some conversations and such. There are a few that are kind of like, I want to say early this year, kind of like leaning into the home equity space and doing pretty well. But then I have some others that are telling me it's like, yeah, we're kind of waiting to see kind of what happens. But, we know with purchase and refis being down this year that this is really going to be a big space for them. So, just trying to see, it's like, okay, well, just kind of keep us in the loop of when you think you're actually going to kind of get into that space, because this seems to be the driver, right? We've had a lot of people that have equity in their homes. They've been wanting to, maybe remodel and such, and we'll be tapping into that. So, the ones that are definitely kind of in there early are seeing some results and getting some applications there. On the flip side, then, with the borrower and defaults, talking to some other people as well in secondary markets, they're looking more towards the end of the year, with what we're seeing right now with the layoffs and things like that, and kind of waiting to see what happens, that it could be more towards the end of the year with like the defaults that exist, but they're kind of, not great to say, kind of gearing up for that more towards, the last couple quarters of the year.
Yeah, that certainly is something that I've heard. I'm attending the servicing conference next month in Orlando, and in talking with some of our prospective customers that are attending, it's certainly top of mind for them, how these defaults or potential for rising defaults are going to impact their books. So certainly more to come on that, but it'll be interesting to see how the market shakes out.
Yeah, and I think everybody, the hope is that rates are going to stabilize, because I think we're like in the 6s and 7s. It's like, please.
Yeah,
please.
I'm hopeful. I'm an eternal optimist, so let's hope. Talking about home equity though, as we started out, we've seen over the past few years the trend of home equity lenders to kind of expand the valuation box. For several years following the financial crisis, 2007 through 2009, AVMs were not looked at very favorably by regulators, but that kind of started to change maybe in the Trump administration. 3 to 5 years ago, that started to change. And what we've seen over the last, like I said, 3 to 5 years is home equity lenders have taken significant steps to kind of incorporate AVMs into their valuation cascade. A lot of lenders are creating an entire valuation cascade that begins with that AVM PCR, cascades to a desktop appraisal, and then maybe out to or terminates with maybe a traditional appraisal. AVMs, I think, in my opinion, should be used in this space, right? Because if you look at you take a borrower that has a high credit score, low LTV, a low loan amount, it's almost like, why should we go all the way to a traditional appraisal, right? It's like using a sledgehammer to pound in a penny nail, right? It doesn't make any sense. And especially for home equity lenders that are covering the cost of doing home equity loans, it makes perfect sense to use a valuation cascade to kind of reduce the overall spend. And I think that's what it's allowed lenders to do, is reduce the overall valuation spend, but it also provides a little quicker turn time, but probably more importantly, gives or provides for the consumer a little better experience. And that's kind of what I've seen. I mean, Michelle, I'd be interested in your opinions on, best practices for AVMs and that sort of thing.
Right. I think there's kind of like a three-prong approach you kind of need to take when it comes to using the AVM products and doing some due diligence behind it, right? You want to validate that AVM and kind of look it over to see, how was that value created? What kind of is going into the valuation? What might be impacting the subject in the way of location and things like that? But then, also then marrying that up with a property inspection and kind of looking that over to see what condition is the property in. Hasn't been, is there deferred maintenance? Hasn't been well maintained? Kind of what's going on there with the condition of the property. But then taking a step further, maybe going to like an evaluation where you're using kind of all these pieces to, judge the quality, calculate for yourself, kind of valuation, and kind of come up with like a reliable kind of review product there, reliable valuation product there, which falls right in with interagency guidelines and things like that. So, but I think it's key not to just accept it for face value, to take the time and kind of unpack it and kind of look at it to make sure does the big picture kind of make sense when you kind of look at these pieces together.
So that kind of leads me into my next question, though. When you say, review it, right? Or look at, I guess, the validity of stuff. Having been in the capital market space and on the lender space, what tools are there? Free tools? Are there paid tools? Like what were you guys doing to kind of look at the AVM, the property condition report, do some type of QC around that? Almost as a sanity check.
Yeah, so just looking at public records MLS, but easy peasy for everybody. Just go to Google or Bing and kind of search the address, look at the the overall aerial photo of the property. In Google, drop that little man down, walk up and down the street to kind of see and get get an idea of where the subject property is located. Is there water? Is there commercial? Are they on a busy street? Things like that. to kind of validate, location and maybe some other factors. But, just simply doing an address search, public records, things like that to, just kind of balance and check that out to make sure that the information that you have is valid.
You also mentioned validation, and I think it's a pretty good segue, because I think, if you look at the interagency guidelines, they do make mention of a validation of the AVM or AVMs that the lender's using, right? So almost kind of a requirement that they're asking for. And up until recently, the cost of validation, I think, was almost somewhat cost prohibitive for a lot of home equity lenders, right? Unless you're doing a lot of home equity lending, the cost of validation to use an AVM was probably keeping some lenders out. And what I've seen recently is valuation providers coming out with an AVM cascade that is independently tested. The cascade is built by the testing entity. And what that's done, or what they've been able to do with that, is really take the cost of that validation and encapsulate it into the cost of the AVM. So the AVM, the increase in the single AVM price might be $5 to $10 versus having to do this massive validation project. And it allows the lender to have the benefit of the compliance and use a validated, and I'll keep independently validated, cascade in place. And I don't know if you've seen increased use in that, and how that's been received at all.
Yeah, definitely see more of the usage of the cascade when it comes to, in the valuation space. Quite frankly, that kind of gives you, like a better answer, because there's some AVMs that are going to perform better in some spaces. There's some AVMs that are, quite frankly, they perform better like in a certain state or market. So, definitely been kind of seeing that.
Yeah, that's the other thing that I've noticed in the testing, right, is that there may be one AVM that performs excellent in, pick a state, pick a county. It's outperforming. When I talk about performance, I'm talking about the accuracy that they're testing for, right? And then that same AVM testing in another state is not as accurate, but another AVM is just as is very accurate. So I think that's the importance of making sure there's that independent testing. It also helps if you're utilizing a cascade, because it gives you typically 2 to 3 AVMs per geography, typically the county, that have tested very well in that area. So I think utilizing or taking that approach and leveraging the testing could really help lenders that may not have wanted to use AVMs or a valuation cascade. I think that's the key there. It doesn't always have to start with an AVM. I think the important thing that we have seen with lenders is they create a kind of a cascade and a policy around where they're going to start in the cascade. To kind of use that example, you've got that borrower that has, a low LTV, super high credit score, low loan amount. Those are perfect candidates for that AVM PCR evaluation component. And then based on the credit profile and the loan profile, you might skip that first step and go right to a desktop appraisal, or depending on the property, if it's complex, skip them all and go straight to an appraisal. I don't know if you've experienced the same thing.
Right. And, I think the key here too is, the connection that you have with the borrower to see, because, where the borrower might miss out, with the ABM and such, is if they just put a whole lot of money into their property and renovated. Because this is kind of like an area to where, something's kind of like an average condition, things like that. But if they have just done a whole lot of renovations, you might want to think about then, moving to a different product, outside of the AVM cascade. But, that's where good communication with your borrower, to know what's going to work best as well.
I think that's important. I think that that's a key piece and point to make is that the AVM is going to assume the home's in average condition. So understanding from your borrower, what's the overall condition? Have you done improvements, right? That kind of helps you determine where in the valuation cascade you're going to start. But that's a good point, Michelle. If it's interesting because I think one of the most interesting developments, at least for me, I don't want to date myself, but I've been in the industry since 1997. And I think, as we all know, it moves sort of at a snail's pace. And one of the most interesting developments in really probably since COVID is the adoption of desktops and hybrids in mortgage. And I think COVID pushed everybody to say, we need to utilize these. The GSEs began accepting literally true desktops, right? Where the appraiser didn't go into the subject property. They didn't run down the comps. They literally did a 1004 from their desk on purchase transactions. And I think that really was, if anything good came out of COVID for our industry, that certainly could be one of them, is that it really just forced everybody at the table to say, we need to look at the alternate use of different products, right? Desktops, hybrids. And I think that has started to accelerate. Freddie released, was it last year, the ACE Plus PDR. And, I think, Fannie, and you could maybe speak to this better, Michelle, you've been on the recent calls, but Fannie's coming out with their version of ACE Plus PDR. And for those that, haven't heard of ACE Plus PDR or are questioning the acronym, it's, automated collateral evaluation, ACE, plus or coupled with a property data report. But you were on a call, was it yesterday or late last week with Fannie? Is there anything that you can tell the group from that call? I know it's
right. I mean, they released to the public back on January 11th, kind of like their equivalent, kind of like get ready, here it comes, with their valuation acceptance plus property data information. So theirs is coming along here and should be coming along, rather soon. Usually when they make an announcement, we get things pretty quickly soon thereafter. But just to kind of back up a little bit, when you're talking about the desktops and, how that was so successful during COVID, and thank goodness, right? Because, it helped things keep moving. That's probably the fastest I've seen Fannie and Freddie launch something to policy ever. But, there's so much data rich environment. We're living in such a data rich environment now that, when we were using those in purchases, the realtors were still doing a really good job with the listings online to be able to get those interior photos and things like that. And now they've even gone to where they're putting kind of the sketches, because we know that, with the sketches for the GSEs, that's a requirement to go along with that. But, when we start then moving in and talking about hybrids, so you kind of hear the word kind of bounce back and forth between hybrid and bifurcated appraisals. So, to help me keep it straight in my head, hybrid was, like the name of the form that Fannie and Freddie came out with. It's their 1004 hybrid. It's their 70H. So when the word bifurcation comes to mind for me, when I hear that, it's like, that's how they've separated the process of, you have, somebody, a real estate person with a real estate background, appraiser, trainee, et cetera, going out and doing the property inspection. But then you have an appraiser sitting at home, sitting in their office and completing kind of like the desktop, the appraisal part of that. So I separate it with hybrid is the product type, and bifurcation is how they kind of separated out the duties. So just how I've kind of separated it in my mind. But no, I mean, these are great steps to kind of launch the industry forward, quite frankly.
So really quick though, we've got a desktop and a hybrid. Same thing, different?
So the hybrid's different in that the appraiser is going to get those photographs, those property inspections, right? With the desktop, the appraiser is using what information they have at hand with MLS, with public record and things like that. So, the desktop is pretty much like solo with the appraiser, where the hybrid is providing some inspection information back to the appraiser, but then they're also looking at MLS and public record as well.
So
differentiate.
You mentioned the 1004H, the 70H form. What can you tell us about the form? Is it a different form? Is it the same form? Like what, if you were to show it to me, does it look completely different? I mean,
yeah, it's just, I mean, it's just about the same, but there's some differences, right? You're going to have differences with the appraiser talking about their scope and how the thing was put together, but then of course the certification about how the kind of the product kind of came together as a whole. So there's going to be some subtle differences in there to be looking for, but it has a grid. It has the comp photos, it's got the appraisal photos, so it's just those things about, making sure the disclosures are there with the scope of work. And then of course, the certification would be, a bit different as well. So, just some subtle differences with that and, your regular 1004.
So the page 1, page 2 kind of looks the same.
The nuts and bolts are the same.
Okay. Sketch too, sketch photos,
sketch
location.
photos, yeah, and
So,
mapping, yeah, critical to have all of those so that you can get a really good idea of what your subject is and such. So got to have the addendums.
And so it's effectively it's the same form. So with the exception of the disclosures is what you're saying. Okay.
Yeah.
That makes sense to me. So, you've been really, really close to the, to this desktop hybrid movement. What do you think the benefits are? Why go down this road? I have my own opinions, but what are the benefits industry-wide, appraiser-wide? What are you seeing as the impetus and why we're all of a sudden now this is making sense and we're doing this?
Yeah. So yeah, it absolutely makes sense. So let's kind of move left to right, talking over some of these bullet points we have there, resolves the declining appraiser population issue. We've been talking about that for a very long time, with, appraisers kind of getting out of the industry as they decide that, it's a career, I'm checking out. But there's a great movement, kind of behind this with the appraiser diversity initiative that's coming, with from like Fannie, Freddie, and through like the Urban League, where they're trying to introduce the next generation of appraisers, a more diverse look at, a more diverse population of appraisers to, to try and kind of fill in the gaps here. But, just in talking about the declining appraisers, we had a lot of people do really well in 2021. And I've seen a lot of appraisers kind of talk out there in the blogs like, hey, it's a career, volume slowing down, I'm done. So we need to be, looking to this next generation of appraisers to, to kind of fill in the gaps when we get, when things start to increase again. That's going to take time. So we're still going to see this, this deficit kind of in the appraiser population. So by having these options for these different products, these desktops, the AVM cascades, it's kind of taking pressure off the appraiser population in that we're, kind of finding a way to work around it, so to speak, but in a thoughtful way, right? Risk-based, making sure it's supported and it kind of makes sense. But, so that's kind of, one of the things with like the appraisers and such, trying to fill in that gap.
it's almost good timing that the market slowed a little bit. I mean, I think we all wish it didn't slow as much as it did, but the slowing of the market and the timing of, these new products getting introduced in the mortgage helps us all kind of, bridge that gap. And if there's different processes we need to do or that sort of thing. I do agree with you with the declining appraiser. It helps with the declining appraiser population because, when you say it's going to take a minute to get the next generation, I mean, you can speak as an appraiser. I mean, if you decided today, I want to be an appraiser, how long does it take to go from, I want to do this to getting a license?
Yeah, well, I think the challenge is, and with, that we're seeing is, not only trying to get the education, the experience or whatever, it's also trying to find those supervisory appraisers, right, to come alongside the ADI program. But, it could take up to, it could take up to like 2 years in order for an appraiser kind of get up to speed with, their experience and things like that. And, the cost that kind of goes along with that. Now, mind you, that's kind of being looked at very closely. I attended the CFPB meeting yesterday about appraisal bias. So they're looking very closely at how the appraisers, how the appraisers and the education piece of that with the PAVE report, things like that. There's a lot of focus on, can we do this better and differently, to get an appraiser up to speed. But again, I mean, these are great alternatives to kind of fill in the gap as we try to figure this out.
So you mentioned something, and I don't want to put you on the spot, but you mentioned the word bias. And I don't want to turn this into an appraisal bias discussion, but is there anything with these that help with that?
Yeah, so let's talk about the customer experience, right? So I think that's where we're hearing most of the noise from is where it's the customer as they're interacting with the appraiser and as they're receiving their report. The one thing about doing some of these these different products is that with the desktop, the appraiser's never seeing a person. AVM Cascade, with a property inspection, you're not going to see who owns the property. The hybrids, the person that is doing the valuation piece is not going to the property and meeting with the appraisers. So you're kind of like helping to improve. Now it's not going to completely solve. It just kind of lessens the potential for that to happen. But this is using the alternative products does then kind of help the consumer kind of separate them from the valuation piece even more and kind of help in that space. So, but there's got to be much growth and much change to come in that space.
Thanks. I didn't mean to put you on the spot.
Oh,
you said the word.
I figured. I know. I stepped in it. That's okay. I'm very passionate about this. I'm following this thoroughly. So yes, you're fine.
You said it. I had to ask it.
I know.
So
let's go to capacity. Can we go to capacity?
That's where I was going to go. I was going to go to the capacity and the quality component, but what does this do what does a hybrid do for appraiser capacity? Because we all know that last year capacity was a major problem, right? I mean, appraisers were, I heard just story upon story where appraisers were getting, 10, 15 orders a day, and just they couldn't even reject the orders fast enough. That's how underwater they were. So what does this do for capacity then?
Right. So just as we were speaking before, it actually puts the appraiser on a full appraisal when it's actually needed, like those complex assignments, maybe somebody's remodeled, things like that. So, when you start to substitute in for like in the home equity space and others, to do a desktop or even do like the AVM or try the ACE plus PDR or Fannie Mae's, when it comes out, the valuation acceptance plus property data, it's taking some of that pressure and some of that capacity and production away from the appraiser space, so that we're able to kind of get that information and get it quicker. Because I know we've always been told the appraiser is kind of the long pole in the tent in this process. So this is kind of shortening that pole just a skosh for you. So, definitely helps with taking some relief off of there. And boy, those appraisers were getting some fees. and extended turn times. So yeah, I was wondering if I was in the wrong end of the business when this was all going on.
Well, from a capacity perspective, I know what we've seen in our own ValueNet business is that, appraisers are able to get, 4 ValueNet appraisals done for every 1 1004. I'll be interested to see what that ratio is from hybrid appraisals to 1004s. It would logic would say, you're clearly going to be able to do more hybrids than 1004s because the appraiser is not doing everything start to finish. They're not scheduling the appointment, driving out, doing the inspection, so all of that stuff is time put back into the appraiser's day. So logically speaking, I can see the appraiser increasing their capacity. So to be able to get more appraisals done with the same population or shrinking population probably is a good thing.
Right. So, and let me just tell you one of the things I've been kind of reading in like the appraiser blogs as well. Some of them are kind of like really happy with this process separating, because we have some people who like to go to the property inspections, kind of meet with the customer, and almost like and complete the information on inspection, in the app and what have you, and then they're done with it. The property's not kind of following them around. The liability is less because they're not having to then crank out a value associated with that, and like the liability is less because nobody's asking them, well, how much are your adjustments, or can you look at these 2 and 3 sales? So there's some that actually kind of like the separation and able to kind of go out and do inspections. But then there's some that are like, I would rather not leave my house ever again, and actually, are maybe coming to the point in their career where they're like, hey, just sitting down at home actually is a great thing for me. I can sit here and do one after another. I'm not in my car driving around, which is great, but I can do what I like. I like to do the analysis. I like to drop in the comps. I like to put in the value, and away you go. So they can get more done, like you said, being able to kind of stay there and separate this process. But actually seen a few that are like, all right, this actually suits what I like to do.
Yeah, I almost argue that we're having the appraiser do the most important part of the assignment is analyze data, right? That's probably the most efficient use of their time, and really what we're paying the appraiser to do is analyze the market. So from a quality perspective, right, we've proven that there's no degradation in quality over the course of the last couple of years through test and learns and different things like that in these products. I think it also has an impact on overall turn times, right? Because a big portion of turn time is trying to get availability on the appraiser's schedule, right? And last year and the year before, appraisers are so busy, they were scheduling out, weeks in advance. But when you use a different pool for that workforce to do the data collection of the subject property, that we've seen have the greatest impact on overall turn time, because there's a bigger pool of, let's say, just use real estate agents, for instance, which are great candidates for the data collection component, right?
Yep.
They're very plentiful, and you can get somebody out quicker to the subject property, and then that all results in reduced cycle times.
Right. And the people that are coming into the market as trainees as well. I will tell you, we got a question. Thank you very much for this question. They're wanting us to please compare and contrast hybrids versus desktop valuations. Again, yeah, we've been kind of talking about interchangeably. So, with the desktop valuations, this is everything is completed from a desk. You're looking at public records, MLS information, and it's a GSE requirement if you're doing one for those to have a sketch provided with you when you're kind of doing that. So you are not getting an inspection. You are just gathering the information that you can from a desk, from public records, MLS, etc. For the hybrids, this is where kind of like I was talking about, that bifurcated process kind of comes in, to where you have somebody going out and doing an inspection of the property, reporting back what they're seeing with photos, filling out, a certain checklist of items. And then that information is then provided to an appraiser to complete like the desktop portion of that, the valuation portion of that. So, there's there are some similarities in the differences between the hybrid and the desktop when it comes to the kind of the what's completed is like, you will not have an inspection component with a desktop. There'd be a certain amount of things that kind of line up with your scope of work. When it comes to the valuation, it's like, hey, I was provided information at a desk. But they will also then talk about hybrid, also talk about the photos were provided as well.
I would throw a caveat in there, because you often hear, at least in our ValueNet suite of products, right? We often hear desktop hybrid used interchangeably, right? So I'll use our ValueNet product Appraisal as an example, right? It's often called the desktop, but there is that inspection component in that product. So the desktop acronym, or tag, with respect to the GSEs, kind of came out during COVID, where they were they wanted to be clear with a 1004 desktop that there was never an inspection. I would say to the group that in the home equity space, we've often hear desktop hybrid kind of used interchangeably. So I think if for anybody that is using a product like a ValueNet or something like that, if you have questions, certainly check with your provider that, hey, is there an inspection? Is there not an inspection? Because I've seen that used interchangeably. It's a little bit different with the GSEs, because they drew the line right down the middle and said, a 1004 desktop, no appraiser is going to see the subject property. The hybrid, the bifurcated process, is the 1004H, 70H. So I just wanted to kind of throw that out, because as we move into hybrids being used in mortgage, right, there's been a lot of kind of commingling of terms. So I just kind of wanted to make that clarification, because it can be extremely confusing, because you hear it all the time. Well, I'm using a desktop, and then, well, wait a minute, is there an inspection? Isn't there an inspection? So that distinction, desktop hybrid, I think really came about in the GSE mortgage space. In that home equity space, we often conflate the terms a little bit.
Yeah, thanks for that extra layer on that. Because I'm always in like the GSE frame of mind.
Yeah, in the home equity
coming from the loan quality center there myself. So
yeah, in the home equity space, we've often used desktop as the description for a hybrid appraisal. But I hope that answers the question and not confuses the issue. But I think it's just important to make sure that there's that understanding of, yes, there's an inspection, or no, there isn't.
awesome.
I don't know if anybody threw a follow-up in there.
No, we are gonna we gotta thank you. So thank you.
Yeah, stop confusing us.
Really, stop spinning me around.
Yeah.
No, but I've been I think we've both kind of been researching this topic as well prior to speaking to it. But I found something very interesting that Fannie had put on their website when they surveyed mortgage executives back in 2022 about appraisal monetization, and 94% of them found that it was going to be a valuable thing. It was going to be valuable to them, and the thing that they liked about it the most was the shortening of the loan experience, like the shortening of the cycle time, which we've got on here, as well as like a reduced cycle time. So this, like I said before, the appraisal piece sometimes felt like the long pole in the tent, but this is a way to help with the cycle time of the loan, keep it moving a little bit quicker. And then of course with a lot of these comes we're talking about like the reduced cost, right? Because you're not paying for a full-blown appraisal. There's a cost savings there between using, some of these, the ACE plus PDR and some of these other products, desktop, et cetera, where you're kind of then saving the consumer. And if you're taking the cost yourselves, then you're saving yourself that cost too over time. So that's a key thing. And I thought that was kind of a very interesting percentage and number when I saw that. It's like it seems like everybody wants this. everybody finds the value in this. It's like, well, now how can you execute?
Yeah, and I think it also is another step towards, we always hear the digitization of the mortgage process or the loan, right? And this is another step towards that. At some time we'll completely digitize mortgage, but I think it's going to take a hot minute. We still got a little bit more work to do. But, if we kind of look at, we talked a lot about appraiser modernization, using various appraisal or valuation products, right? Certainly at this point, home equity loans that are kind of held in portfolio and not sold on the secondary market, servicing in default. These are areas that are really well suited for expanding the valuation box, meaning, can we leverage AVMs, PCRs? Can we leverage, I'll keep the term consistent, hybrid appraisals in home equity, or as we sometimes call them, desktops? Can you use these in portfolio, servicing in default? I think these are areas right now that we see our clients use a variety of these valuation products. Until the Fannie and Freddie make policy the use of hybrid appraisals, I think these are the key areas where lenders can leverage these products and help reduce their overall spend, because in all of these, typically, at least from my experience, the lender is absorbing the cost, and that could get expensive. So if you're going to use traditional appraisals all the way through the whole process. So I think there's room to explore. I think for those that are not using or haven't expanded the valuation box, and I've talked to a number of different lenders over the course of the last couple of years, my advice to them is just dip your toe in it, right? I mean, nobody says you've got to, completely, send everything through, a different box, but identify a subset, right? If you're not using, let's say, if you're still using traditional appraisals in home equity, take a subset of that borrower profile and move them into, let's say, a desktop appraisal, hybrid appraisal, right? Where there is an inspection. Once you're comfortable with that, then you maybe move into an AVM PCR. Nobody says jump all the way, let's jump right into the deep end of the pool. But it certainly, I think, makes a lot of sense to start exploring those. And how can you control, how can you reduce the overall cost? Where does it make sense? Where doesn't it make sense? And I think that's the point that, Michelle and I were trying to make, is appraisal modernization is here to stay. It's expanding into or out of home equity and portfolio and default, and it's expanding in the mortgage. And although we don't have any timelines around when it's going to be policy, I think we're going to see things move a lot faster. And hopefully we'll see those announcements come out, because I think it benefits everybody. It benefits the consumer. It benefits the lenders. We're not increasing risk. And at the end of the day, if it's going to provide a better consumer experience, to be able to broaden the box for valuation, I think we kind of owe it to ourselves to explore that. I don't know if you agree, Michelle, but I hope you do.
Yeah. Sure. Yeah, yeah, absolutely. And have used some of these alternative products in secondary markets for loan pool sales, things like that, because I didn't need it. But when, like you said, when you're looking at it, test and learn, have your regular appraisals that you're doing, but then go alongside it with an alternative product to see, like, kind of validate it, in your own mind to say, okay, this is going to work for us in this space and not. So the validation process for yourself, is key.
I appreciate that. I don't know if there's any additional questions. We'll kind of hang out here for a second to see if we've got any other questions that come through. Happy to answer anything that the group might have.
Yeah, really appreciate everybody coming. And we did have that one question that we had. Anybody else
Yeah,
has any
like
others?
I said, hopefully we didn't confuse everybody, but it is a term that gets kind of used a lot, and they kind of conflate it a bit. So if we've got no more questions, I certainly appreciate everybody's time. We kind of went about 50 minutes today, so we'll give everybody a few minutes back in their day, but thanks for your time today. We really appreciate it. And for those folks that are on the call that are customers of the Accurate Group, we certainly want to thank you for your partnership. We are very grateful for the opportunity to work with you.
Thanks, Isabella, for hosting us. Appreciate that.
Of course. Thank you guys so much for joining us. And with that, we must conclude today's program. This session has been recorded and will be available within 3 to 5 business days. On behalf of the Consumer Bankers Association, thank you to Frank and Michelle, and of course, all of today's participants. Have a great afternoon, and you may now disconnect.